£1 million. Is it a great profit or not? Well, it depends. If you have a million of investors, then this means that you just get £1. But if you have just two investors, each of you gets £500,000, and that looks fantastic, right? That's why we need IAS 33 that guides us how to calculate earnings per share. So profit after tax divided by the number of shares. But here is the trick. The thing is that we can actually issue shares that are sold at a market price, and this would be quite fair. So this is the valuation of the company, and if you want to join our group, you need to invest as much as we do invest right now if we were to sell and buy back the shares, right? But what could happen is that there would be bonus issue, so at no cash, rights issue, so at less cash, and we would need to calculate earnings per share, recalculate. Good news, for SBR we don't need these calculations. Those who take financial reporting exam, well, you have to calculate them quite a lot. The chance of numbers being tested in SBR is quite low, so I would say that you shouldn't invest your time there. What you should invest your time in is understanding why the standard is important. And the standard is important because of the other part of it, where we have to calculate diluted earnings per share. So, diluted earnings per share. It's not about what we have now, but what we are going to have in future if we have some shareholders that appear out of nowhere. Remember, like when you watch some TV series like Succession, for example, sometimes you have this meeting, the shareholder meeting, and they are voting for someone, and then there is someone who stands up and says, I have convertible bonds and I'm converting them now to shares, and now I am holding the major voting power and I think that we should do this. And everybody who was planning some very mean, some very bad plan, they are like, oh my God, our plans are not going to work. Well, that is an example of dilution. And dilution means that you have issued some instruments that are going to lead to new shareholders appearing in the company. So, for example, when you issued share options to your employees, then in 2, 3, 5 years, your employees will become shareholders, and this means that there will be more people who are going to pretend to get a claim on this 1 million profit. Or, for example, if you have convertible bonds, then again, those bond holders, they can choose whether to convert or not to convert, and then can become the shareholders of your company. And yes, you're going to save some money because this means that you don't have to repay them cash, and this means that you don't have to refinance it with the bank. This means that you don't have to pay loan, but still, your earnings per share most likely is going to fall. It's going to be diluted. Fun fact, if you are going to open Tesla's financial statements, and if you are going to look at its earnings per share and diluted earnings per share, so what these earnings per share would be should the investors that hold these very instruments appear now, you will see that the difference is significant. And that would be important for you as an investor to know about that, right? So, once again, what is diluted earnings per share? Why is it important? Well, because the investors would like not to be surprised when new shareholders appear. What is the problem of diluted earnings per share? Well, diluted earnings per share looks at possible future investors, and this conversion, these share options can result in shares in, let's say, 5 years, 10 years from now. So it can be pretty far away, and by this very time, I as an investor could have sold my shareholding in this very company. So it wouldn't be very much relevant. Also, when we are looking at the diluted earnings per share, the problem is that we take current profit, but future number of shares, which is quite silly, right? Of course, the profits are going to rise by that time. So it could be a little bit misleading. But on the other hand, how will it work with the new standards? Why IAS 33 becomes even more important now? Well, that is because with IFRS 18, we have this great importance of APMs, additional performance measures. And those performance measures allow company account management to disclose something that they feel they want to disclose, like earnings before interest, tax, depreciation, amortization, underlying profit, and so on. And these measures, they won't be IFRS based. So IAS 33 now is actually something that is very important to investors, that is used in many investors' ratios and looked at by many investors, but still is guarded by IFRS, and it can be used in order to compare the results of earnings per share with the advanced performance measures. And the additional performance measures. And this could give the investors the idea of whether that could be manipulated or not. And it was Lilia Kirilenko, and please subscribe to this SBR Made Easy podcast, because in here I tell you how SBR will be tested so that you are not surprised when you get to the exam. And there will be many more episodes to follow. And make sure that you participate in my weekly SBR quizzes on my LinkedIn. All the details in the comments in the description below. Bye!